Over the past several days, a quiet shift has been taking shape beneath the surface of the silver market. It is not the kind of movement that grabs attention through headlines or dramatic closing prices. Instead, it is the sort of development that only becomes visible when you slow down and compare how different segments of the market are responding to stress. These moments are often the most important because they form without consensus and without a ready-made narrative to explain them. By the close of trading on January 15th, precious metals looked at first glance largely uneventful. Both gold and silver finished slightly lower, the kind of modest pullback that could easily be written off as routine consolidation after a strong advance. Intraday pricing showed silver spending much of the session in the low $90 range per ounce, while gold hovered near recent highs with minimal change. Taken on their own, the closing prices did not signal urgency or alarm. The intraday action, however, told a more complex story. Earlier in the session, silver experienced a sudden and sharp drop, unfolding over minutes rather than hours. Moves of that speed usually occur where liquidity is concentrated, areas where resting orders are clustered, and where volatility can accelerate once price begins to slide. The decline measured several percentage points from high to low, enough to trigger systematic selling and force mechanical responses from short-term traders. This was not a gentle drift lower, but a fast flush that briefly changed the tone of the tape. Under normal conditions, such an aggressive move in the metal would be echoed, often amplified, in the shares of companies that produce it. Silver mining equities and related exchange-traded products typically exhibit operating leverage to the underlying price. When silver sells off hard, miners often fall harder. That relationship did not fully assert itself during this session. While the metal dropped sharply early in the day, mining equities declined far less. Public pricing data showed only a fractional pullback relative to the metal, followed by stabilization. By late morning, much of the early weakness had already been recovered. A divergence like this does not guarantee anything on its own. Markets produce false signals all the time, especially during volatile periods. Still, when a commodity and its associated equities behave differently under stress, it is worth paying attention. Futures traders, options hedgers, and equity investors operate on different incentives and time horizons, and those differences tend to surface when markets are under pressure. One straightforward explanation is structural. Mining stocks are influenced not only by spot prices, but also by broader equity market conditions, balance sheet strength, and expectations for future cash flows rather than immediate price fluctuations. When the broader equity market is relatively stable, miners may be less sensitive to brief shocks in the commodity price. Viewed this way, the divergence could simply reflect temporary decoupling driven by cross-market factors rather than anything deeper. Another interpretation focuses on relative strength. When an asset declines less than its underlying driver during a sharp move, technicians often see that as a sign that selling pressure may be diminishing, at least in the near term. It does not mean a reversal is guaranteed, but it can suggest that incremental sellers are becoming scarce at current levels. To understand why this matters, it helps to revisit how mining businesses actually respond to changes in metal prices. In the short to medium term, mining companies operate with relatively fixed cost structures. Industry disclosures show that many silver producers report all-in sustaining costs that fall within a fairly narrow band, reflecting labor, energy, maintenance, and regulatory expenses. These costs do change over time, particularly as energy prices or wages move, but they tend to adjust far more slowly than spot metal prices. When silver trades near production costs, margins are thin and profitability is constrained. When prices move meaningfully above those costs, margins can expand rapidly. This is the operating leverage that defines the sector. At current price levels, based on publicly available cost data, margins across much of the industry appear substantially wider than during past cycles when silver traded far lower. That alone does not define fair value, but it helps explain why equity investors may be reluctant to aggressively sell miners on short-term volatility if they believe the pricing environment has shifted structurally. Skepticism is still warranted. Cost inflation remains a real concern. Energy, equipment, and labor expenses have risen over recent years, putting upward pressure on sustaining costs. If costs were rising as fast as or faster than silver prices, margin expansion would be far less meaningful. Financial statements suggest that while costs have increased, they have generally lagged the rise in silver prices, though the picture varies widely by company and jurisdiction. Jurisdictional risk also continues to weigh on valuations. Mines operating in regions with regulatory uncertainty, changing tax regimes, or political instability often trade at persistent discounts to peers in more stable environments. That discount can remain even during strong commodity cycles if investors doubt the durability of favorable conditions. From this angle, restrained equity performance may reflect caution rather than mispricing. Market structure adds another layer. Derivatives, particularly options, can exert significant short-term influence around predictable dates, such as monthly expiration. These periods often coincide with heightened volatility and unusual price behavior as positions roll off or are adjusted. During such windows, sharp intraday moves in futures or spot markets can reverse quickly, while equities respond more slowly. What looks like a divergence may simply be the result of mechanical positioning effects. Even so, the interaction between short-term mechanics and longer-term fundamentals is often where larger moves begin. When repeated bouts of volatility fail to produce sustained downside in related assets, it can indicate that the balance between buyers and sellers is slowly shifting. These changes rarely announce themselves clearly. They appear as a series of imperfect signals that only make sense in hindsight. History offers mixed lessons. In some precious metals cycles, miners lagged the metal for months before accelerating sharply once confidence in higher prices grew. In others, apparent divergences resolved through consolidation rather than expansion, with equities eventually realigning to lower metal prices. At the time, the difference between those outcomes was rarely obvious. The current environment is especially complex because of the broader macro backdrop. Precious metals are trading at elevated nominal levels alongside strong equity markets, reflecting overlapping investor motivations rather than a single narrative. Some participants are focused on hedging currency risk and preserving purchasing power, while others remain positioned for continued growth in risk assets. Mining equities sit at the intersection of those views, influenced by both commodity fundamentals and equity sentiment. In that context, the muted response of silver miners to sharp intraday volatility becomes less about predicting what must happen next and more about understanding what is already being priced in. Equity prices represent collective expectations filtered through uncertainty, risk tolerance, and competing opportunities. When they resist moving in lockstep with short-term shocks, it suggests that some investors are looking beyond the immediate tape. As the market approaches the next inflection point, the relationship between spot prices, derivatives activity, and equity performance remains worth watching. Not because any single session will settle the broader debate, but because the way these components respond to stress reveals where pressure is building and where it is being absorbed. The first place to look when you see this kind of divergence is not the headline price move, but the plumbing beneath it. Silver can drop sharply for reasons that have little to do with long-term demand and much to do with how liquidity is distributed across futures, options, and ETFs at a particular moment. If the early decline was driven by a rapid sweep through resting orders, the more relevant question becomes which structures were vulnerable and why they were exposed at that time. Silver trades as a continuous auction dominated by derivatives and short-term positioning. Mining equities trade as discounted streams of future cash flow, constrained by equity market dynamics and longer investment horizons. When these different participant groups react at different speeds, you can get a session where the metal appears to break down, while equities quietly refuse to confirm the move. That refusal is not proof of anything, but it is information. Quantifying operating leverage helps clarify why miners can ignore a brief price drop. All-in sustaining costs vary by company, quarter, and jurisdiction, and are influenced by byproduct credits, hedges, grades, and accounting practices. Still, a reasonable range can be estimated. Over recent years, many primary or near-primary silver producers have reported sustaining costs roughly between the high 20s and the 40s per ounce. With silver trading in the low 90s, even the higher end of that range implies substantial margins. That margin funds dividends, debt reduction, buybacks, exploration, and optionality, and a brief intraday dip does little to change the quarterly economics unless it persists. Mining equities also reflect more than spot prices. They carry debt structures, streaming agreements, hedges, and exposure to other metals. Many are held by funds that rebalance on schedules indifferent to intraday volatility. If the sector is underowned and valuations still reflect skepticism, persistent price-insensitive buying does not need to be dramatic to matter. It only needs to absorb selling. Valuation remains a delicate subject. Miners are not cheap simply because silver is expensive. They are cheap if the market is discounting a return to much lower prices, higher future costs, operational disruptions, or political risk. Mining equities are shaped by scar tissue from past cycles, memories of dilution, and broken promises. That history often causes them to lag early in a bull phase. But when confidence in higher prices begins to solidify, re-ratings can accelerate quickly because the starting point is so skeptical. There are credible counterarguments. Silver may simply be overextended, and the drop could mark the start of a deeper correction. Miners may appear resilient only because equity investors are slow to react or because broader equity markets are supportive. The divergence could also be technical, driven by ETF flows, index adjustments, or short covering rather than fundamentals. The only way to sort through these possibilities is to observe how relationships evolve over multiple sessions. Does miner outperformance persist during choppy metal prices? Does the ratio of miners to silver trend upward? Does volume suggest accumulation or mere stabilization? And does silver itself hold key levels long enough to undermine the idea that the spike was purely temporary? Options expiration often clears the board of vulnerable positions, but it can also expose what was previously masked. Once forced hedging flows diminish, price action can become more directional. Sometimes that means continuation. Sometimes it means a vacuum. The early session flush on January 15th can be viewed as a stress test. Silver failed at intraday by dropping sharply, but passed another by recovering. Miners faced the same test and, based on relative performance, behaved as though the stress was insufficient to alter longer-term cash flow expectations. From here, the focus shifts to execution. Margin expansion only matters if it translates into free cash flow, balance sheet repair, and disciplined capital allocation. Some companies will strengthen themselves, others will repeat past mistakes. The sector's reputation hinges on those choices, and the market's skepticism reflects the belief that high margins may be squandered. If that perception changes, the re-rating can broaden quickly. Mining also faces a fundamental constraint: time. New supply cannot be brought online quickly. Permitting, financing, and construction operate on long timelines. Underinvestment during years of low prices shows up later, not immediately. That lag does not guarantee tightness, but it does make elevated prices harder to neutralize quickly. Demand, meanwhile, is multifaceted. Industrial use, investment demand, and substitution all interact in nonlinear ways. Some users may cut back at high prices, others cannot easily substitute. Investment demand ebbs and flows with sentiment and macro conditions. These dynamics are messy, which is why short-term price action should be interpreted cautiously. Equity markets discount uncertainty aggressively. Even strong current margins may be treated as temporary if investors believe prices will retrace. Balance sheet strength and consistent capital discipline are among the few levers miners have to change that perception over time. The most defensible stance, then, is conditional. If silver holds higher ranges and companies continue to report robust margins, the probability of a gradual re-rating rises. If prices fail to hold, the apparent resilience of miners may prove fleeting. Both outcomes remain plausible. What matters most is observation rather than conviction. How silver and its producers respond to stress, consolidation, and opportunity reveals more than any single narrative. The signals that shape markets are often quiet and persistent, not dramatic, and they work their way into pricing gradually as participants adjust expectations in real time.